You are listening to The Vocal Technologist. Spoken tech for your ears.
All right, everyone, welcome. It's Web3 Wednesday here on The Vocal Technologist, and we have quite a bit to get into today.
Definitely. The crypto world never stops moving, does it?
It really doesn't. We're going to try and make sense of some key shifts, big institutions stepping in, the whole decentralization debate heating up again, and stablecoins doing some pretty interesting things behind the scenes.
Yeah, lots happening.
So let's jump right in. First up, the mainstream getting serious. Nasdaq. They've filed with the SEC. What's the plan there? Tokenized stock trading.
Exactly. And not just as some side project. They want to offer it right alongside traditional stock trading. Customers get to choose legacy or on-chain.
Wow. Okay, so equal priority. And how does it work? Is it completely separate?
No, that's the clever part. It uses the existing plumbing, the depository trust company, the DTC, for clearing. And if you hold the tokenized stock, you get full shareholder rights.
So it's not like some watered-down version?
Not at all. Think of it like,
Exactly.
remember moving from analog tapes to digital music? It's a format upgrade for finance, a structural shift.
That makes sense. And we're seeing companies already using crypto assets in traditional ways, right? Like SharpLink Gaming.
Yeah, that was interesting. They used their, $3.6 billion in Ether and zero debt to fund a huge $1.5 billion share buyback.
Leveraging crypto holdings for standard corporate finance moves.
Precisely. Boosting the ETH value per share for those still holding. It shows how these assets are becoming, just another tool in the financial toolkit for some companies.
Okay, so that's the institutional side warming up. But then there's this other constant theme, the sort of tug of war. True decentralization versus more centralized control.
Always. It's the core tension, isn't it?
Yeah. And you see cool things on the decentralized side, like Aerodrome's launch model, no pre-sales, no paying market makers, just the community providing liquidity and setting the price.
Which is refreshing. It gets back to that community-first ideal. And you see platforms like Coinbase trying to support that with their DEX integration, opening it up to more retail users.
Trying to counter those extractive dynamics, as they call them.
Right. But the challenge is real, especially with things like MEV.
Ah, MEV, the invisible tax. Explain that a bit. How did this become such a big deal?
So MEV, maximal extractable value, it's basically when those who order transactions, miners or validators, can subtly rearrange or, censor them to make extra profit.
Right.
It started almost like an unnoticed side effect, a bug, if you will. But it's evolved. It's now a sophisticated system that's pulled over $1.1 billion out of Ethereum users' pockets since the merge alone.
$1 billion. Wow. And layer 2s don't fix this.
Well, here's the twist. Layer 2 rollups, which are meant to help Ethereum scale, often introduce their own central points of control. Specifically, the sequencer, the entity that orders transactions on that L2.
So a new bottleneck.
Pretty much. And it's profitable. Estimates suggest a network like Base could earn anywhere from $50 to maybe $200 million a year just from controlling that sequence.
Which creates a huge incentive not to decentralize that part.
Exactly. The economics push against it.
It feels a bit like, remember Facebook's Libra? Or now Stripe's Tempo project, aiming for its own chain. This tension between the original open crypto idea and these slick corporate-controlled chains.
That's the heart of it. Can a chain run by a big tech company with its own products and priorities ever truly be neutral? The incentives often point towards favoring their own stuff.
So instead of a decentralized revolution, we might just get new digital empires.
It's a real possibility, a risk we need to watch.
Okay, so connecting all these threads, institutional moves, the decentralization fight, what does this mean for the bigger economic picture, especially with stablecoins humming away in the background?
Right, stablecoins. They play this fascinating, almost paradoxical role. By creating global demand for dollars, because people use them to trade crypto, they actually inadvertently help support U.S. monetary policy.
How so?
Well, that demand helps the U.S. government finance its huge deficits more easily. And where does some of that deficit spending go? Into critical areas like, believe it or not, funding AI development and research. It's a strange loop.
Wow. Crypto demand indirectly funding AI via U.S. debt.
It's one of those complex, interconnected flows. So for you listening, thinking about where to focus, maybe it reinforces the idea of investing in the shovels.
The infrastructure.
Yeah. The stable blockchain networks themselves, the reputable exchanges, the major assets like Bitcoin and Ethereum that form the foundation, rather than purely speculative tokens, the core plumbing of this whole system.
That's a really practical takeaway. What an exploration today, huh? From Nasdaq adopting tokenization to the deep complexities of MEV and sequencer control, and then this unexpected stablecoin impact on global finance.
It's definitely a lot to track, constantly evolving.
Absolutely. Well, thanks for joining us to unpack all of this. It's clearly an exciting, but also really complex space right now. So as you think about everything we discussed, here's something to chew on. With all this innovation and these competing forces, institutional adoption, the pull towards centralization, the grassroots push for openness, will the future of finance on-chain truly stay open and decentralized? Or are we just seeing the early stages of new digital empires taking shape? Definitely something to ponder. We'll catch you next time.
Spoken Tech for your ears.